So maybe you can just help orient the audience about what exactly does Pershing Square Capital do? What's the general investment style, and why did you set it up that way?
So the vast majority of capital invested in the markets today is passive. So if you think of index funds or ETFs or even the big kind of long-only institutions, the vast majority of that capital is by charter passive. Passive means you do your research, or in some cases you don't do the research. You sort of just blindly follow an index and you're judged based on how closely you follow the index. If you think about investing 100 years ago, though, you had Andrew Carnegie owning 20% of U.S. Steel, or you had J.P. Morgan as a large owner of various companies over time. And in the old days of investing, an owner would act like an owner. So if they were unhappy with the performance of the business, they would replace the CEO. If they were unhappy with the board's judgment, they would make changes to the board. And as capitalism sort of democratized the investment process, and as any kid in business school can open a brokerage account, and as the owners of many of these great businesses over time, gave the shares away to a university or their heirs, and the ownership was spread out, the Sam Waltons of the world kind of passed away, and the boards became to be managed by professional owners. And so what we do is we look for situations where a business has lost its way, where an otherwise great company in a business that we would define as one that has significant barriers to entry, that Warren Buffett would describe as having a moat around it, a business that is simple, predictable, generates cash, and we can be confident will be here 50 years from now. A good example is we own a stake in Canadian Pacific, which is a railroad in Canada. And if you think about the railroad business, it's a business where they're not going to build a new one across the street. Absent some fairly dramatic changes in technology, you can be pretty comfortable that goods will be shipped on rail for a very long time to come. So it's a business we can predict. We can think about it from a very long-term perspective. We can buy it at a price that's interesting. And in the case of CP, this was the worst-run railroad in North America. It had the lowest profit margins. It was trading at the lowest valuation relative to earnings, and had a very unhappy shareholder base, but there was nothing they could do about it because they were inherently, again, the biggest investors tend to be very passive.